Hello. In this video, I will be talking about the 3 building blocks for developing a successful investment program. Basically, if you want to apply some sort of logic to your investment program, beyond just going on stock tips or recommendations, where you want to come up with the investment ideas yourself, you probably want to implement either one, if not all 3 of these building blocks that I'm going to talk about. The first one is a thing called fundamental analysis. And throughout this video, instead of saying fundamental analysis over and over again, I'll probably just call it FA. The second area is technical analysis, and I'll probably just refer to that as TA most of the time. And then a third area that's often overlooked, which is probably the most important block, is mental analysis. Overcoming your own emotions or using the market's emotions to your advantage. Fundamental analysis, or FA, what is that? What FA tries to do is determine a stock's real or fair market value. Another word that is often used is intrinsic value. What is that stock really worth? After you do all of your analysis, you break everything down, you come up with a number that you think that stock should be worth. Then what we do is we look at what is the current price of that stock. So you compare what you think the value of that stock should be with the current price of that stock. We put stocks into 2 basic categories: expensive stocks and inexpensive stocks. To be an inexpensive stock, you look at the current price and you notice that it's below the price that you've determined that stock should be. So what you do is you buy those stocks or purchase those stocks because they are considered to be inexpensive. Then we look at stocks that have a current price that is believed to be above fair market value. These stocks are sold because they are considered expensive. So the idea is you buy it when it's inexpensive and then you sell it when it's considered to be expensive based on your analysis. When you're watching the financial channels, whether it's Bloomberg, Fox Business, CNBC, Yahoo, any of the different sources that are online, most of the time when they have guests, these are fundamental analysts. Wall Street employs an awful lot of these people, and they constantly sit in a room and they crunch their numbers and they come up with what they think is the fair market value. So instead of you doing all the work and coming up with your own idea of fair market value, they do that for you. And you would be surprised at how much they don't agree with each other. There might be 20, 30, 40 analysts for one particular stock, and they all come up with a different answer. So what a lot of websites do and a lot of services do is they'll take the average. They'll say, okay, the high was 40 cents per share, the low is 20 cents per share. Most of the people are right around 30 cents per share. Oh, right now the stock is trading at 15 cents per share. We think that's a buy recommendation. If you don't like that, then you can learn how to do fundamental analysis yourself and come up with your own figures. You do this by using what is called a top-down approach. You start with the big picture and then drill down into an individual index or individual company. There are different macroeconomic factors that you look at. This is big. These are big picture items. This can include things that are outside of a company. Then you look at different microeconomic factors, and these are things that look inside a company. Let's look at some of the macroeconomic factors. This can be the current state of the economy. Every month, I do a video about the economy, and I offer my own analysis and commentary as to how I think things are going. This is something that I study all the time, but I only do one video each month about the economy. Then I look at different sectors. Now, when we're talking about the S&P 500, what they do is they take all of the stocks that make up that index. There's currently 505 or 506 stocks, and they break all those stocks down into 11 different sectors. We also might look at domestic issues. Specifically, what's the government doing? Now, a lot of times, the stock market doesn't really pay attention to Washington, D.C. all that much, but every once in a while, there'll be new rules, new regulations, there'll be changes that they do away with, there'll be new things that are added, and this can really impact a company. We're seeing a real shift now as we move towards the modern monetary theory type of implementation, which is kind of a new economic theory that's being implemented. And a lot of that is focusing more on the new Green Deal and climate change and things like that. We have to be aware of those things, whether you agree or disagree that those are good things. That doesn't really matter at this point. A lot of companies are taking on this concept and implementing it in their companies. Then we have different geopolitical factors. What's going on around the world? What's happening in Japan? What's happening in Europe? What's happening in China? What's happening between the US and Russia? What's happening between the US and Japan or US and China? Sometimes these can have an impact on the overall fundamentals of a company. Other times, they don't really have much of an impact. And we need to study all of those things to figure out what is important and what's not important. Then we look at what is the market fixated on, and this changes almost on a daily basis. It might be an economic report that came out. It might be an earnings report given by a specific company. It might be something that's happened with the whole pandemic. It might be a host of different things. And this is where it becomes interesting because sometimes good news is seen as good news, and that will drive prices higher. Sometimes, if we're worried about the economy going too fast, good news can actually be bad news. And the inverse of that can also be true. It may not make logical sense, but that doesn't matter. We have to figure out what is happening in the markets. Then we look at different macroeconomic factors. This can be the management. You might like a certain stock because you really like the management of that company, maybe the CEO or some of the key executives that play a real role in that company. Or the revenues. Are they seeing a nice increase of revenues over a period of time? If you're seeing nice growth, you might really like that as an investment. Also, there are different earnings. And specifically, you usually break these down into earnings per share. And then what do their future growth prospects look like? They may not be all that great of a company right now, but they might have something in their pipeline that you really like, and so you decide you want to invest in this company. Then we have return on equity, and then profit margins. A company has to eventually make profits in order to stay in business. Now, when a company starts out, it may not have profits for a long time, and investors may still really like that company. Amazon traded for years and didn't make a profit. It was a big deal when they showed their first profit. Now they're a very profitable company, but a lot of times when companies are young and they're starting out, they may go many, many years before they actually see any profits. And it can be a host of other things. This is one of the things that you'll find frustrating about FA is that no matter how much you study, no matter how much you know, no matter how many spreadsheets you look at, there are still things that you don't know about that company. And so a lot of people think, okay, they've uncovered enough information to make a good decision about that company, where other people, they do all this analysis and they're going, wait a minute, there's still a lot of things that I don't know. And so now instead of having a real conviction about an investment, you're just kind of, well, I hope this works. We can also use fundamental analysis as it applies to indexes. The Dow Jones Industrial Average, that's the most famous one that people usually talk about. If somebody says the market's up, the market's down, or it's up 1,000 points, down 1,000 points, they're usually talking about the Dow. But that's only 30 stocks, so it may not be the best index to use. Another one that people often refer to is the Nasdaq 100. The Nasdaq has thousands of stocks. Well, there's an index that just takes the 100 largest Nasdaq stocks and just puts them into an index. And a lot of people just focus on that. I focus on that very heavily. And then the index that I focused on the most is the S&P 500. And a lot of times I'll just refer to that as SPX. We have two different categories that we use with this. There is quantitative analysis. This is the quantity. This allows for actual numbers and measurements to be used and calculations to be performed. This is when you're trying to figure out their earnings per share, or are they making a good growth in revenues year over year. These are things that you can actually measure and then try to project out into the future and see if that will continue or if that will stop. Then there are other things such as qualitative analysis, and this has to do with quality. This is a lot harder to measure. Something like key executives, maybe they have a hotshot CEO. And if that CEO leaves, what's going to happen to the company? Maybe they have a really good management team that has a new approach to doing things, and you really like that. Brand name recognition. If you have a brand name like Coke or Pepsi or Microsoft or Apple, a lot of people buy things just based on the name. Other things can also include patents. What do they own? What inventions or new products do they own the rights to? And then what are they currently developing? What are their future products? Some products really are successful. Other products are not so successful. Remember Betamax, VHS? At one time, Betamax was considered the king, but then VHS ended up winning out. There are different standardization methods that are used in the industry that you might think we're going in one way for a period of time, but then ultimately we end up going a different way. And then different proprietary technology. What do they do that's unique? Or they may have methods that are unique. They have a different way of doing business than other companies. Some of the drawbacks of FA are that forecasts, whether you come up with them or if you hear them from other people, no matter how educated, no matter how long you work, no matter how many numbers you crunch, these are estimates. We don't know what's going to happen in the future. So these are guesses. Yeah, we think that's what will happen, but we don't really know for sure. We are predicting at that point. Some people really get a thrill out of that. Other people are successful at that. Other people don't really like that uncertainty, or they're not very successful at doing those things. Analysts publish buy or accumulate, they usually change the word there, recommendations. But these recommendations, whether it's buy, hold, or sell, they can change over a period of time. Additionally, there may be a reluctance on an analyst to recommend selling a stock. And think about this. It makes sense. If you analyze a company, well, you need to get in and know some of the people in that company. You need to get to know the management, the CEO. You need to go visit the company. You need to look at their products. You need to try out their products. You need to look at their different retail stores if that's what they do. And all of a sudden you come out and you say, this company sucks. Do you think they're going to welcome you back in next time? Not necessarily. They're probably going to show you the door if you're even going to get that far. Or they're not going to return your phone calls or your emails. So analysts are under some pressure to make sure that they either make good recommendations or they sugarcoat their bad recommendations. An analyst may not want to bash a company, which can also compromise their objectivity. You may really like a product or a company, and that's fine. Don't let it ruin your own objectivity. You want to analyze this investment to see if it's a good investment. Don't let your own preconceived notions dictate what you do or don't do. Fundamental analysis can involve any aspect of a stock, which leaves room for many unknowns. And that's what I stated a little bit earlier. No matter how much you study, no matter how much you analyze, no matter how much you know about a company, there's still things that you don't know. And that leaves a real question mark as to what will happen in the future. Pure fundamental analysis. Let's say you decide, I'm a fundamental analyst. This is all I do. I am Warren Buffett. He's probably the most famous fundamental analyst. He doesn't really care what the market's doing or what the price of the stock is doing. He's digging into these companies and seeing what has value and what doesn't have value. He's not always right, but he's not always wrong either. That's probably why you've heard of him, as he's had a track record of good success. A pure fundamental analyst doesn't really concern themselves with other disciplines like technical analysis or mental analysis, the other two areas that I'm going to cover in this video. If you want to learn more about fundamental analysis, and there's a host of books out there, but the one that is probably cited as being the best book or the first book to have in your library, if you don't already have it, is called The Intelligent Investor. It's been around a long, long time. It's written by Benjamin Graham. You can easily find it on Amazon. However, this is kind of a dry book. It's a lot of number crunching. If you're the accountant type or maybe an engineer type, you might really dig this stuff. But other people, they'll pick up this book when they're having trouble sleeping because within minutes they'll be fast asleep. It's not necessarily cutting edge excitement when you're reading this book. But if you want to be a successful investor and you want to learn how to do things using fundamental analysis, you're going to want to spend your time in this book or books like this. Now we look at another area called technical analysis. This is a type of discipline where you look at stocks or indexes, both of them, and evaluate what is happening in that index or that stock by looking for trading opportunities based on the current price and the trend of that price, whether it's going in an uptrend or a downtrend, different patterns that you see on a chart, and then implementing those patterns or those charts to help you make good decisions on when to get in and when to get out. What you do is you look at past trading activity, things that have already happened, and you take that past activity and different price changes, and then you can use those to calculate what are called indicators of future price movements. So based on what has happened before, we believe that we can predict what is going to happen in the future. Technical analysis assumes that all current prices for an index or a stock reflect all known information. Remember back at fundamental analysis when I said that there are certain things that you don't know? Well, technical analysis assumes that everything that we know about that stock that's publicly available and maybe even some insider information is already reflected in the price of that stock. So everybody sees the same price at the same time. We don't really concern ourselves as much with fundamental analysis because we're looking at the current price, believing that everything that is to be known about that company or index is known at that time. This also focuses on the statistical analysis of price movements. And as I said, there's all kinds of different ways that you can do this. There are different indicators or calculations that you can plot on different charts, and that can give you insight as to what's happening with that stock or with that index. Also, it makes an attempt to understand current market sentiment. Are people really positive about the market right now? Are people really negative about the market right now? We can look at that using technical analysis because we generally want to do the opposite. If a lot of people are going one way, we want to go in the opposite direction. It's not going to feel like the right thing to do, but quite often it is the right thing to do. And we also make an assumption with market sentiment that most people in the market don't really know what they're doing. And we want to be the educated ones. We want to make the good decisions. And so we often will go against the crowd. So stocks and indexes, you'll find over a period of time, looking at them on charts, they do have a random nature to them. There's sometimes when prices are just gyrating all over the place and they really don't make a lot of sense. There are other times when they are non-random, when we can pick out patterns or trends that are happening in the market. We can use this with technical analysis to determine, are we in a random environment? That's when we don't have a trend. And we can look at that and know what kind of an environment we're in and then make decisions based on that. There are some other assumptions that are made using technical analysis. This assumes that markets discount everything, whether it's news, whether it's an earnings report, whether it's a CEO leaving the company or a new CEO taking charge. All of that is immediately discounted into the market. Another assumption is that prices do move in trends much of the time. Now, some people think they move in trends all of the time. There's a big percentage of the time when the market does not trend. And then we also assume that history will often repeat itself. If a stock went up based on this kind of news in the past, we then assume that it will go up the same way in the future. These assumptions also can lead to self-fulfilling prophecies. We have millions of people at any given time looking at the same thing at the same time, and if something happens that makes them want to get in or get out, we're watching that as well. And we might use that as part of our decision-making process. How do we implement TA? Those who implement technical analysis use a thing called indicators that I've talked about before. These are calculations. A lot of these calculations are done based on the price, they're based on the volume, or they're based on price and volume together. The goal is to seek insight for determining the likelihood of future price movement. There are thousands of indicators out there that have been developed. Some of these are in books. Some of these are freely available on the internet. Some of them you might have a subscription to a certain website where you get these indicators. You may have developed your own indicators. Can you get some unique insight? Can you see what other market participants are not seeing to give you some kind of an edge on getting in or getting out of the market? Participants typically find and use their favorite indicators. There's an indicator called the MACD. Yeah, it's usually one of the first ones that you learn, and a lot of people love that indicator. There's another indicator, which is more of a momentum oscillator, called the RSI. A lot of people really like that. What you'll find is people that have been doing this for a while, they find their favorite indicators. I have my favorite indicators that I use, but I don't necessarily use them to make all of my decisions. You have some people that will use just one indicator. There's a whole system based around this. You might use a number of indicators together to confirm each other. What technical analysis enthusiasts focus on are price trends. You want to be in the trend. If the stock or the index is going up, you want to be long. If the stock or index is going down, you want to be short. You're also looking at different chart patterns, and there's a host of different chart patterns. Some of these chart patterns are very effective, and some of them are really only good in hindsight. Like we have a head and shoulders top or head and shoulders bottom. Yeah, that's been effective in the past, but as it's happening, we may not really realize that it's happening, or we might put our own subjectivity into what we see developing on the chart, and we might be wrong about that. There's a different kind of analysis that we use called Fibonacci and using Elliott Waves. It's a great way to determine the overall pattern of a stock or an index. The only problem is, as that chart is being drawn, you have to be very subjective in what you think is happening at that time. All of these charts that I've looked at, they're great for telling you what already happened, but that doesn't really do us an awful lot of good. We need to know what's going to happen from here and into the future. We also look at volume and different momentum indicators. What is the current momentum? And you may hear me talk about that quite a bit. The trend is one thing. We might be in an uptrend, but have one or two down days, but the overall trend is up. What is the shorter term momentum of the market? We do have indicators that calculate more quickly, and they give us more insight as to what's happening on a shorter term basis, where other indicators that we use, such as moving averages, they may take a long time to turn directions. Then we also look at oscillators. And the easiest way to explain what an oscillator is, think of it like a fan that you turn on and it goes so far in one direction and stops, and then it goes all the way back over to the other direction and then stops. That's what an oscillator does. It has an upward range and a bottom range, and you are looking at these types of indicators. When they get too high, that means something is overbought. And we're generally anticipating some kind of a pullback at that point. If something goes too low, then we consider that to be oversold, and we're looking at some kind of a bounce. The only problem with oscillators is they can be wrong, or they may be overbought or oversold for an extended period of time. So we're sitting here waiting for something to happen, but it might take longer than we feel comfortable waiting for that to actually play out, if it plays out that way. Because by the time that oscillator actually confirms it by showing us a calculation, the environment may have changed. And then moving averages. And that is probably one of the most common indicators. And it's one I use very heavily as well. We also use a thing called support and resistance levels. How high up can it go before it runs into resistance and it's going to come back down? How far low is something going to go before it finds support? And we have intraday levels that are calculated each day. And the cool thing about that is we know those levels before the market even opens. And you would be surprised to know how many times we get just to one of those levels and things either slow down and turn around and go the other way, or they meet a lot of support or resistance that takes a lot of volume to push them beyond that point. It's really an amazing thing to watch. What I've done in the program that I teach is a thing called the consensus approach. Because I'm asked all the time, what are your favorite indicators? You use technical analysis a lot. What do you really like to do? Well, my answer is my favorite indicator is all of them. Now, you're going to go kind of a little bit weird and say, wait a minute. You're looking at all these things? Yes. Every day I have about 300 charts just on the S&P 500 that I look at. And I look at all of those charts and I just dig out those charts that are actually telling us something. One day it might be the RSI. The next day it might be the MACD. Another time we might be in an oversold or an overbought condition. The trend based on moving averages might be something that we focus on. I look at all of these different indicators together, and I call this the consensus approach. I don't use one or two or three indicators together. I'm using a whole library of indicators, and I'm developing new ones, and I'm testing out new ones all the time. And other ones that don't really seem to tell us anything, I throw those away. I reach a consensus as to what I believe will happen. And this is a skill that you have to develop over a length of time. And this is what the SPX investing program teaches. This is called the consensus approach. Sometimes I may refer to it as the consensus method. Multiple popular indicators are used in conjunction with each other to give a broader view and evaluation of just the S&P 500 index. That's what I focus on the most. For those of you that do invest in individual stocks, this can still really benefit you because you have that saying, a rising tide lifts all boats. If the market is going up, your stock has a tendency to go up as well. If the market is going down, your stock may have a tendency to get sucked down with everything else. Having a broader view of things can still really benefit you even if you trade individual stocks or companies. All of the different strategies that I teach are based on just the S&P 500. And I have a lot of reasons for that and a lot of things that I teach about this, but I'll get to that in a different video. Some of the flexibility of using technical analysis is this allows for different markets. I've been talking about indexes and stocks, but you might trade bonds, you might trade futures, you might trade Forex, you might trade all different kinds of things, gold, oil. Technical analysis can be applied to the different markets. If you want to branch out into other areas, technical analysis will give you that flexibility. Also, different time frames. Now, I don't condone day trading. That's just not my thing, and I don't teach that in the program that I teach. But if you use daily charts to make decisions, I do use intraday charts, and I follow things as things are happening. I just don't get into the market with the idea of getting out that same day. You might have charts that look at 10 minutes or 60 minutes or one day, weekly charts, monthly charts. You can use all of those together to reach a consensus about what you want to do. Another thing that TA allows you to do is make adjustments. You can change the different calculations that are used for these indicators. You can modify them. You can add your own. You can try different periods of time. And you can also experiment. Try something out and see if it works. It's one thing to back test something. It's another thing to forward test something. I do that every time. When I say I'm looking at new indicators, I'm usually in the process of forward testing them before I even talk about them. A lot of people find that using visual cues, looking at a chart, is very helpful. You can see things unfold. You can look at a picture of things, and that kicks in a different part of your brain, and some people think that that helps make better decisions. Some of the drawbacks are that technical analysis does have some disadvantages. Analysis paralysis. This is what I was talking about. There are thousands of indicators out there, and if you try to use all of them together without really understanding them, you're never going to be able to make any kind of a decision because you are paralyzed with overwhelming information, and a lot of times this is contradictory information. And so you may just get to the point where you're like, I can't do anything. This happens to a lot of people. I've had a lot of students over the years. They're very good at analyzing the market. They really want to do well. But when it comes down to crunch time and actually making a decision, they always freeze up or find a reason not to do something. That can be a real drawback because you have all this information that's coming into you and you just feel overwhelmed. Changing market climates. I alluded to this earlier. What works in one particular market climate may not work in another market environment. You'll see if you get a lot of emails like I do from the different people that teach this stuff, if something becomes the current fad, that's pretty much when it's over. For example, we went through a period of time back from about 2012 to up until the election in 2016, where the market spent a huge portion of the time not trending. We had an overall upward bias during that time, but it really wasn't convicted to go straight up or straight down. We had some bumps along the way and so forth, but we spent a lot of time really going sideways. And so this one type of strategy where you sell things into the market became very popular. Well, that's great as long as that current climate continues. But if things shift over a period of time, you're going to see some hefty losses if you use those approaches. Just like if the market's really going up or really going down, you'll see trend-based programs or strategies. That works great as long as the market is trending. But when conditions change, what worked in the past may not necessarily work right now. And then we have this never-ending search to find the perfect indicator. We think that it's out there. We think it might be an algorithm or some kind of an indicator, or we do all this studying and analysis, I know because I've been there, trying to find those things that really tell us something all of the time. It doesn't exist. There have been times when people have come close, but it really is not out there. If you want to go ahead and prove me wrong, please do that, because I've spent a large part of my 25 plus years of studying the markets trying to find that perfect indicator, and I haven't found it. So I've concluded that it really doesn't exist. And if you look way back in history, people have always thought they found the holy grail to the markets, only to have it work for a period of time and then it will eventually break down. And there's some very smart people that have lost a lot of money because they committed to a certain approach only to have that approach disintegrate over a period of time. And then there's inconsistency. It may work at some times, but it may not work during other times. And then subjectivity. This is one that really gets me. I go to a webinar or something and somebody's showing me their latest and greatest indicator package that they're trying to sell me. And then on top of that, then they start showing me their little nuances and their little tricks and their little ways that they do it. And I like to do this and I like to do that. And it's like, wait a minute, am I learning a skill for myself or am I just becoming a clone of what you're doing? And that's what a lot of people out there teach. And I find that not to be very effective. You might get a book that has all these great answers, but can you adapt it to who you are? Can you adapt it to your personality? A lot of times that answer is no. Sometimes that answer might be yes. And if you've found that, let me know. I would like to know what you've been able to uncover. But this is what I've observed over the years. If you want to learn more about technical analysis, a really good place to start is the book written by John Murphy called Technical Analysis of the Financial Markets. It's been around a while now. There are updates that come out periodically. There's research that might be a little bit outdated, but if you want to learn the basics, this is a really good place to start. It's not a cheap book, but it might be a book that is well worth having in your library. Now let's look at another area, and this is an area that's often neglected. This is dealing with your brain, dealing with your emotions, dealing with fear and greed. So this area deals with understanding the fear and greed that each one of you, each participant, needs to control. And in fact, we try to take fear and greed and use them to our advantage. We have it under control for ourselves, but we're dealing with millions of other participants that don't have it under control. And we're going to use that to our advantage because they're making the wrong decisions at exactly the wrong time, while we're making the right decisions at the right time. This is what you want to implement if you want to experience consistent success. What is consistent success? Is it saying win after win after win? Well, that doesn't do you much good if you have an annualized return of, let's say, 8%, but the S&P has an annualized return of 10%. You didn't beat the market at that point. If the market is getting an average of 10% a year, you want to be 12 or 15 or 18% a year. That's what people are trying to achieve, to get above average returns. But many fail in this area. And so what we do is we try to get in there and we try to do better than what the market can do, where most mutual fund managers and a lot of hedge fund managers, I would even say most hedge fund managers, can't even beat the S&P 500. So why even try? So the alternative to this, let's say you don't want to try to figure this out. You don't want to use fundamental analysis. You don't want to use technical analysis. You don't even care that much about mental analysis. You're worried about the fear and greed. You just want to set up a systematic program that you do month after month or year after year, where you have long-term growth in mind. You're going to have 20, 30, 40 years of this in order for this to work. To get average returns, you might use a thing called dollar cost averaging. So when there are setbacks in the market, you're putting the same amount in, let's say $100 a month or $1,000 a month. Well, when prices are cheaper, you're buying more. And so over a period of time, your average price actually gets a little lower. And an assumption that over lengthy periods of time, the markets will go up. Now, if you go all the way back to 1900 or so, if you look at the Dow or the S&P, or different indexes, you'll see that, we've pretty much have gone up over the last 121 years or so, but there have been some real downturns during that time. If we see some of those downturns, how are you going to react to that? What are you going to do mentally? What are your emotions going to do? Because when you're involved in that kind of an environment, you're going to do exactly the wrong thing at exactly the wrong time. The markets have a real way of doing that to people. But what if this assumption changes? Yes, we've seen 121 years of consistent growth. What if we go through an extended period of time where we don't see that, where the markets don't bounce back, where all the tricks that the Federal Reserve is doing, suddenly they run out of their tricks, and all this stimulus is just causing hyperinflation instead of actually getting the economy going? What if we see an extended period of time where things really fall? There's a lot of people out there predicting that. What's going to happen? I don't know. But we want to be ready regardless of what does happen. And we want to be able to take advantage of that. We want to be mature, smart, and intelligent participants in the markets and make the best decisions that we can. If you want to learn more about mental analysis, a really, really good book on this is called Trading in the Zone. It's written by Mark Douglas. I would really recommend this. And this might even be a good book to read first if you're brand new to the markets. Because if you can't get a hold on your emotions, all the technical analysis classes and fundamental analysis classes that you want to take, that's going to fly right out the window. If your emotions ultimately dictate what you do, if you play things on hunches, if you just get an inside tip that you think you can rely on, if you depend on other people to tell you what to do, read this. This is a really good book to start off with. We also have another thing, and I don't pay a lot of attention to this. I basically disregard this hypothesis, so that's where I'm coming out right now. But it's called the efficient market hypothesis, and there's a lot of people that would disagree with me on this. The efficient market hypothesis, or EMH, disagrees with both fundamental and technical analysis. They just throw that right out the window. What EMH believes is that neither FA or TA can do better than the market. This is the premise that they use. Different market participants take advantage of an opportunity for above average returns because all stock prices are adjusted on an ongoing basis, so that you can't really outperform the market. It's very unlikely that you will do that because prices are already adjusting. And the people that know more than you and have more money than you do, they're already taking advantage of that, and there's really nothing left for you. There's some truth to be said for that. But at the same time, do we want to rely on this completely? We know this exists, and we know that parts of this can be true at different times, but we don't want to base everything around this hypothesis. That's why it's a hypothesis and not a theory. What is the conclusion that we can reach from this? fundamental analysis, technical analysis, and mental analysis together play an important role when selecting a stock or if you trade an index. I suggest using all three of them. Take the good parts from all three, put them together, and develop a program that way. Each type of analysis can be used individually by itself or in conjunction with each other. A lot of people will use fundamental analysis to uncover good investments, and then they'll use technical analysis to decide when to get in and when to get out. So they use those together, but a lot of people really neglect the third area, and that's mental analysis. And I really stress that in my classes. That's the big area right there. Each type of analysis has its perspective, strengths, and weaknesses. I have developed what I call the consensus approach. I not only have that as it applies to technical analysis, I have that as it applies to all three of these different areas. I take all three, put them together, and reach a consensus about what I think will happen. Am I always right? Of course not, but I'm right a lot more than I'm wrong. And I put out videos every day and every week that talk about my conclusions. The idea behind my program is to teach you this skill so that you can take this information and develop your own skill to reach your own conclusions. This is a more effective approach where you can use all three together at the same time. This is the method that's taught in what is called the SPX investing program. Those are the classes that I teach and the videos that I put out each day and each week and each month. So I want to thank you very much for taking the time to watch this video. If you desire, please click either a like or dislike on this video. That'll really help things out. Please leave me any comments. That's what I really like. Also, consider subscribing to this channel and clicking on that little dinky bell there to be notified when new videos are posted. And I'll see you in the next video.